Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on the market action. We're looking at losses across the board. The markets under pressure following that very strong ADP report out before the bell this morning. Yields are heading higher. When you take a look at the action in the S&P, off right now just about 0.7%. So pairing some of the earlier losses that we did see was off nearly 1.5% at the lows of the session. The Dow off just over 300 points. But the big story is the move that we're seeing really in the bond market today. Yields hitting levels we haven't seen for quite some time. We have the 2-year above 5%, the 10-year above 4%. Well, the ADP jobs report really driving the market action today. Stocks lower after payroll data showing that the private sector added almost 500,000 jobs in June, more than double the street's expectations. Here to discuss more, we want to bring in Francis Newton-Stacy, Director of Strategy at Optimal Strategy. Francis, it's great to see you here. So certainly we are seeing some fear, I guess, creep back into the market just in terms of how aggressive maybe the Fed is going to be on the heels of what, at least from the ADP report, is painting a picture of a very strong jobs report. I'm curious, what do you make of the action we're seeing in equities and the bond market reaction?
So it's interesting because basically, you had the Nasdaq going up all year alongside rates. So that negative correlation had broken down. And then you had the S&P go to a negative correlation with the dollar. So some of these correlations were breaking down. And that would have indicated that we're moving over into the time when growth and inflation are decelerating, and then we're going to start to recognize that. And usually then the dollar correlates with gold and gold moves higher as you sort of unwind a heavily inverted yield curve and get into potentially a credit situation. Today, of course, is exactly the opposite of that. You have tech selling off, although we're off the lows. You have rates moving higher because of that very surprising number. And it will be fascinating to see if after the revisions that remains that high, if it's an outlier or tomorrow's jobs numbers reflect that as well.
The big jump that we've seen in yields, though, Francis, you think that's a move that's justified given where we are?
I do think it's justified. I do think that the Fed is going to remain resolutely hawkish unless they are given a specific reason, which means problems in the credit market, to reverse course. They still have to get inflation down. We haven't seen credit problems yet other than SVB. They were able to shore that up. And so unless we see something going on in credit markets, I think they're going to continue with their hawkish rhetoric because inflation is sticky.
Francis, what the yield curve inversion that you just mentioned, obviously something we've been talking about now for quite some time, a reliant indicator, at least in the past, just of predicting a recession. That hasn't exactly happened, at least when you take into account what exactly is going on in the market today. What's different this time around?
Well, we do have some anomalies from COVID, just as far as how much money was put into the system, right? So when you start taking, it's actually debt that's put into the system, and when you start removing the liquidity, you can't remove the debt, and that's what creates the credit situation. As far as the yield curve inversion, there's usually a 14 to 16 month lag when you start raising rates to really see it affecting consumerism. We're sort of on month 15. It seems like it's been so much longer because the rate at which rates have risen, actually. And I do think that, every time except one time in the late 90s, a yield curve inversion has ended in recession. And 11 out of 14 times that the Fed has tightened, that's landed us in a recession. So I still think we're not out of the woods yet, particularly with the commercial real estate. We have $3 trillion on the banking balance sheet, so that is very large. And we have about $1.4 trillion coming up for renewal in the next 2 years. Those rates have changed dramatically, whether they can negotiate extensions, whether it's not worth it because the capacity, they're not full, and whether or not they just send the keys back. There's all of that risk in the system. Then you've got the bifurcated economy. You've got the upper 40% spending, clearly. You've got the lower 60% they're spending, but they're living paycheck to paycheck. You've got record amounts of credit usage with record amounts of rates on credit cards. So you just have to see when something breaks. And every day that we tighten, because there's a lagging effect to the rate hikes, the credit risk increases. So we just have to watch the things that indicate that. But up until then, if we don't see anything, I can see that tech is going to do well, and it's the calm before the storm.
Francis, let's pick up on that point. You say, everything is fine until something breaks. I mean, this concern within the commercial real estate sector is something that many guests have flagged. We've heard Jay Powell talk about many times during his press conference. What are you anticipating? What is the scenario that's waiting on the other end when some of these developers won't be able to pay their mortgage in?
I mean, that's just the thing. So the cap rates have gone down and the rental income has gone down. So now you're asking for around double the debt service with less income, and in some cases probably half of the income. And so it will just be up to the individual companies or what have you, whether they just send the keys back. And to the extent that you see a lot of companies sending the keys back and giving the buildings back to the lenders, then you have a lot of default risk in the system. And, it looks more like long-term capital management. We don't seem to have that in the residential space like we did during the financial crisis, because people are just unwilling to give up their 3% mortgages that are 30 years. But in the commercial real estate space, you have so much maturing in the next 2 years. It's not like they can just extend their loans unless they negotiate that with the lender. And so it just remains to be seen how much of that is where they'll actually just let go of the buildings.
How much of that risk do you think is priced in, if at all, to the market right now? Because the market and investors have largely been dismissing so many of the risks that seem to be lingering still.
Yeah, there are two schools of thought, right? That everything's priced in because we know about it, but we just have no idea what percentage of that market is going to be at a default risk. And it's just like, what percentage? So you've got 70% of millennials and Gen Zers are living on paycheck to paycheck, right? And have a lot of debt on credit cards, and they're buying now and paying later kind of thing. What percentage, when you keep raising rates, what percentage of that consumer base is going to fall off? 50% of millennials are being supported by their parents to some degree. Okay, when does that end? Does that go on forever? So when you see the credit risk, and you've seen some of the inflection points in these delinquencies, bankruptcies and auto loan delinquencies and people not paying their phone bills. Okay, so then you have to calculate to price that in. What percentage of that actually becomes a default risk? And we're too far out. And if everything was priced in, markets wouldn't move again. Somebody said that earlier this year. I don't remember her name, but I thought that there is something to be said for that, for sure.
Francis, central bank policy is still very much in the driving seat when you think about where the markets are headed, but we've got the summer earnings season just around the corner. What's your expectation there?
Yeah, so one of my data providers said that 16 companies have been reported so far, and they're tracking for a negative 21% year over year. I haven't seen that reported elsewhere, but the thing is that it's whether you're looking at the rate of change from earnings off of the peak, or it's whether you're looking at whether or not we're beating expectations against these crazy comps that are coming up. The second quarter, the comps are very tough. And so it's going to depend on the market reaction. It's going to depend largely upon that. But we are decelerating. There's demand in the background that is decelerating. CapEx is decelerating. There are things that are decelerating in the background. It's just the labor market is hanging in there, and we don't see a huge credit situation. Credit spreads are muted so far, but that's what I'm watching for, because historically, when the Fed tightens, that is what stops them from tightening.
Francis, what do you think we'll see from tech? Because last quarter, when you take a look at what happened in the first quarter, there was lots of fear going into those results. Tech, though, a lot of those larger tech names were able to prop up some of the disappointing results that we got elsewhere. Microsoft, one of those standouts. Apple, obviously, another one of those names. Do you think tech is going to do that again this time around?
So the thing about those mega caps, which are kind of holding up the market, if you look at it, I think Microsoft and Apple is around 14% of the S&P 500. They can play with margins. There is a lot of demand there. They have tons of cash on the balance sheets. Those companies are not going away. But whether or not we see the breadth in the market improve is going to be the conversation of, is that really the case for small businesses? Is that really the case for small and mid-cap stocks? And I don't think it is. I don't think that they have that resiliency. And I don't know about margins. We'll just have to kind of see. The supply chains have kind of worked themselves out. I just don't feel like we're completely out of the woods from COVID yet, because we added so much money to the system. We have this, record amount of debt across the board, whether you're looking at, national debt or you're looking at total debt. And, as you start to tighten, you hit a threshold where you can't service that debt. And that's the thing that the Fed is watching for. And I know that they're watching everything I'm watching. So he probably already has a pivot in play should something else break down, like SVB, which would be the first shoe. And that was sort of de facto a hard landing, but they were able to shore it up very quickly.
Yeah, at least for now. All right, Stacey, Stick around, because we have a lot more to get into with you. We want to get some of your picks, how to play what is really adding up to be a pretty confusing time here for the market. So we'll get to that later on in the hour.
Well, Meta is looking to cash in on Elon Musk's troubles, officially launching its new tech service, Threads. It's seen as the biggest threat to Twitter, and Facebook founder and CEO Mark Zuckerberg saying in a thread that the app already has 30 million signups as of this morning. For more on what this means for the future of social media, we welcome in Ryan Heath. He is Axios global tech correspondent. Ryan, Mark Zuckerberg didn't just thread. He actually posted a tweet for the first time in more than a decade, sort of trolling Elon Musk. Should Musk be concerned based off the results on one day?
I think he's very specifically trolling Elon Musk. Look, this is going to be a long play. We don't know how profitable Threads is going to become, but it's clearly having a very quick ramp up. The users that I see when I go on the app are very enthusiastic about being there. You see it with the stock price, certainly not going down like a lot of the rest of the market today. And Elon Musk has created a bonfire out of Twitter as a business. And it was never the best business to begin with. So I think Zuckerberg is clearly on a winning streak at the moment. And the question is just whether he can play that forward into a real long-term winning streak and take over from Twitter. But he's got the bones of a very successful platform here.
Ryan, what do you think he needs to do in order to play that forward, in order to get a similar type of traction that we've seen on Twitter? Because when you take into account what's happening at Threads versus what's happening at Twitter, the two don't exactly stack up. It's not exactly an apples to apples comparison.
Yeah, it's a tricky one. So my view on it is that they're aiming for something between LinkedIn and Twitter. You are able to post 500 characters on Threads, so it's a little bit more substantial, a bit like the original Facebook posts back in the day, but not the sort of brief format that we have come to associate with Twitter. Now, the problem is, since Twitter was launched, aside from the internal problems within Twitter, we've become a more partisan country. The world has become more divided. People want to gather less in one place. And that was the real selling point of Twitter at its height, that it was kind of a global town hall or global town square. I'm not sure that Threads is ever going to be able to get back to that point. But what Meta is very good at doing is collecting more of your data than a lot of other services, targeting the ads very specifically at that, being a safe place for those advertisers. So Mark Zuckerberg doesn't have to fully replicate Twitter's cultural moment and success in order to create a really profitable business.
I mean, that's exactly what I was going to get at, Ryan. Mark Zuckerberg's never been known as an innovator, but he does know how to scale. If you look at Meta, well, formerly Facebook's past track record, how big of a revenue driver can Threads be when you consider there's a lot of advertisers who remove their ads from Twitter who may be looking for a little new, maybe some new real estate?
Yep. So Twitter, when it was doing its absolute best, was bringing in about $5 billion a year. And if we look at Instagram and Facebook, they're bringing in 50 billion plus each a year, like a combined total of well north of 100 billion. So there's a lot of headroom there for Meta and Mark Zuckerberg to be able to play with. Now, of course, we know that they don't really know how to monetize WhatsApp. And that's another huge success from Meta in terms of user engagement and user numbers. So Threads could go the WhatsApp way and not be a big money spinner, or it could go the Instagram and Facebook way, in which case it is kind of rescuing the company from the kind of Meta detour that they took, this sort of failed venture and rebrand into the metaverse. That doesn't look like it's picking up steam or revenue anytime soon.
Ryan, Threads is not available, at least yet, in the EU. A lot of that due, at least according to the reporting, to regulatory concerns. What does that potential rollout, do you think, look like in the EU, or what do they need to prove in order to get the okay to launch in the EU?
Yeah, it's not so much that they need permission to launch, but we see this with a few other services at the moment, from OpenAI, the makers of ChatGPT. They threatened to pull out of the EU if a specific AI law came into force. We've had others be worried. Google's been worried about its Bard chatbot and so on. So I think this is a case of Meta just being very conscious that they have been wrapped over the knuckles and fined before when they merged WhatsApp and Facebook. They did a lot of behind the scenes knitting of the data there, and the EU was furious and felt they were lied to. And I think they want to avoid falling into the same sort of billion-dollar trap over Threads. So there's no clear timeline about when they're going to enter the EU market, but that also tells us two things. One, those user numbers, that 30 million, it's probably 40 million by now, if we're honest with ourselves, those were all obtained as users outside of the EU, except for a few techie folks using their VPNs and whatnot. So as soon as they go into Europe, those numbers are going to spike again, which is good for them. But it tells you that there really is a long runway here. So whatever happens in the US, there's a lot of global growth that they can look forward to. And that makes it really hard for Linda Yaccarino, the new CEO of Twitter. Her whole value add was to be the safe pair of hands for advertisers, to coax more of those advertisers into the Twitter fold, get them to increase their spend. And now Meta is just offering you this great one-stop shop umbrella. And so if you're a nervous advertiser, you're going to stick with Meta probably at this point. You're not going to roll the dice on Twitter.
Ryan, what does the launch of Threads today tell you about Meta's long-term vision, particularly around social media? I mean, is this just about Mark Zuckerberg taking advantage of an opportunity he sees with advertisers moving away from Twitter? Or does this tell you something about the broader ambitions and how he's trying to build up the app space?
Look, I think that they're in a comfort zone. They aren't that old a company, but they've been around going on 20 years now. And their biggest successes in the last 15 years have really come from copying and buying up other companies. It hasn't come from homegrown innovation inside Facebook. So that might be like disappointing at an inspirational level or for the people that want to see true entrepreneurship, but it's very smart. They've done an amazing job with their original scale at Facebook. So to use that scale and marry it to a canny ability to spot a competitor's weakness or another model that works well, that's now a well-established playbook at Meta. So, I think it's kind of predictable and it's smart, but it's not sexy in the sense of someone coming up with a new invention and inspiring us at all. But it's going to make Mark Zuckerberg and Meta shareholders a lot of money, I think, in the long run.
Yeah, which seems to be the excitement, at least around Meta shares and this launch. Ryan Heath, Axios global tech correspondent, appreciate you joining us today.
Thank you.
We are just getting started here on Yahoo Finance Live. Coming up, we're checking in on a few stocks to watch and a few you should be staying away from. Plus, 71% of small business owners are optimistic about the future, but could higher rates and economic challenges bring rain to the parade? We're going to focus in on small business later in the hour. And we are just 2 weeks away from the Barbie movie. Will the high-priced marketing pay off for the summer blockbuster, or will Doll be a disaster? That and much more when Yahoo Finance returns.
Investors on edge today as a strong ADP report suggesting more rate hikes could be on the table. We're back with Frances Newton-Stacy from Optimal Capital. Go through some of the stocks that she believes are the best bets right now. Stacy, let's start off with gold. We're not too far from those record highs where we were just about a month ago. Why do you think it's still a very good hedge at this point?
Okay, it's selling off for sure because we've had this rise in tech, but I do think that as the credit risks increase, as we go further with rate hikes and we get further away from our first rate hike and the lagging effects of the rate hikes come in, I still think that, that affects real rates, and real rates affects the price of gold. You start to have a correlation between the dollar and a positive correlation between the dollar and gold. And I do think, again, there is credit risk in the market, so I would be buying the dip in gold because the other things that have taken off this year are, don't want to chase those trades.
Yeah, and we have seen, gold often move as a safe haven trade as well. Let's talk about the other one that you're looking at right now, the iShares MSCI Japan ETF. Japan, a story that has been well covered here in terms of why we have seen so many foreign investors pile into the market, specifically around corporate governance reform. What do you see that's attractive there? Is it about valuations? Is it about opportunities in relation to what else is out there right now?
Yeah, they're just at a different place in the business cycle. So when you look at the global tightening and you look at the weakness in Europe and you look at the weakness in China and you look at the, we're still resilient, but, some potentially upcoming weakness in the US, Japan just looks more attractive from the monetary policy standpoint and, their rate of inflation. They don't have that issue that the Fed has, which is, trying to get inflation off of the 5-handle for, the yearly numbers. So that's the difference, basically. Frances,
when you take into account so many traders have been piling into this trade, I think a lot of people are asking just what exactly is going to be that catalyst. I know you mentioned the moves there from the central bank, but outside of that, what's going to keep that momentum moving in the right direction in that market?
Well, it's just the macro policy. So, what's interesting is that we just have to wait and see. But the thing about it is when growth and inflation are declining, or when you have stagflation, where inflation's going up and growth is declining, it tends to be the global macro, the top down, that kind of dominates the system. And, when you have growth and inflation going up, or just growth going up and inflation going down, it tends to be the bottom-up stock picking. And so we're in this environment where the global macro and the rates and the central banks are still, I think, driving the bus. And so then that's the difference. And, that would be what I would watch.
I mean, with that said, isn't it also a very different market in that inflation hasn't gone up to the levels that we have seen in places like the US or Europe, largely because of the demographic shifts too? And how much of that do you have to consider when you think about, whether this is a short-term play or a long-term play?
Well, for me, I'm just, China looked great because China earlier was easing, and they were the sort of outlier in the fact that they were easing. And then, of course, the Chinese picture changed pretty dramatically. So I think in this environment globally, I think for me, I want to be more tactical and not say, well, definitely there's a demographic change and that does support a longer term outlook, but I'm just watching those central banks. I'm just watching the monetary and fiscal policy and the liquidity levels. Because I think that's what's really in play. And I think that, Japan becomes an alternative to the rest of the world that's tightening. And that, that's creating demand in Japan that, is coming from existential and external factors. So I don't know how sustainable that will be.
Frances, let's talk about some of the picks that you don't like, some of the names that you're saying to avoid. Technology, obviously a massive winner in the first half of the year. Guess we're approaching some overbought levels?
Again, just being tactical. Yes, this stuff is, it's risen so far so fast. So when we look at technical analysis and we talk about reversion to the mean, some of the angles and the trajectories that tech has gone up on, Tesla has gone up on, it's just not sustainable. You're going to have a pullback, even if it's in a larger bull market. And while I fully believe in AI and I fully believe in technology and the strength of these balance sheets, I do think that we're going to have some credit problems potentially in the second half of the year. So I would be a little bit more tactical and defensive.
Even with that said, there's been a number of analyst notes that have gone out specifically on Tesla, downgrading the stock, but also reiterating the long-term play, right, in terms of where they stand in EVs particularly. Is that where you stand on that stock? Is it just about the incredible run-up that we have seen and this entry point just not being sustainable?
Yeah, and I'm more of a technical analyst, but yes, I agree with that because I believe in the future of AI. I believe in the future of EVs as I do AI. The thing is that we're hitting some double top and triple top resistance in the tech space, and it's the angle that it's gone up on that I do think that it never hurts to take some money off the table, because what happens is you have these massive moves and then people tend to hang on and they sort of round trip. And particularly in this environment, volatility has been very muted, but I do expect that the VIX is going to go up into a higher range as things start to occur later in the year, and that's going to, affect tech and affect Tesla. So I think taking a little bit of money off the table here never hurt anyone.
We'll leave it on that note. Frances Newton-Stacy, Director of Strategy at Optimal Capital. Good to talk to you today.
Well, stock sliding and yields heading higher after the strong jobs report data, triggering some fears of more rate hikes. Here with a closer look at today's action, Yahoo Finance's Jared Blickery. And Jared, 10-year above 4%.
Yes, that is a big milestone here. We hit that earlier in the year, and that was just before the SVB unraveled there. This is a 3-month chart, so let me show you a year to date, and that's going to show you here we punched above 4% ever so briefly at the very beginning of March, and we know the story with the mini bank panic we saw, the internet bank panic, and it was down there. Now, over the last 2 days, we shot up over 20 basis points. We've come off of this, and just given the strength of the move, I would expect a little bit of consolidation, but I would not be surprised if after consolidating, we move above and start to use that 4% level as a support level. If that happens, it's off to the races, and I think we're going to see more damage in the stock market. However, on a longer term chart, maybe this is a double top of sorts. If that's the case and it's coming down then that should be supportive of more equity strength in the second half. And of course, it depends on what you're looking at here. In the first 3 days of this year, I was looking at the sector action. This is what's happening today. Everything is in the red, but over the first 3 days, you can see real estate, utilities, staples, and communication services. Only those sectors are green, and the top 3 are defensive sectors. Communication services is mainly a meta story. You take a look at inside the Nasdaq 100, a lot more red than green, and that is a very different picture from what we saw in the first half. So Tesla's up 6%, but for the most part, the mega caps not really contributing the outsized gains that they were contributing before. Want to show you some interesting things here. Here's the bank stocks over the last 3 days. Here's the regional bank stocks over the last 3 days, a mixed bag. But then semiconductors, this was one of the leading sectors. We're seeing that down significantly, AMD down, NVIDIA down. Here's software, aside from Microsoft, the big kahuna there, most of that in the red. And I'll show you something really interesting with respect, and maybe this is kind of a referendum on the consumer. Here is our food heat map. And if you're buying Coca-Cola, Pepsi, Kraft macaroni and cheese, Mondelez candy, looks like people are in this space right now. However, you take a look at who's going out or investors in the space of going out here, restaurants, everything's in the red for the most part, and some dark red as well. Then you take a look at the quick service restaurants, fast food, also a sea of red. So staples over discretionary, maybe a theme, or maybe it's just the fact that this is a very, very low volume holiday week.
All right, 3 days into the second half of the year. Certainly a lot of red on that screen. All right, Jared, thanks. Well, coming up, BlackRock's Larry Fink no longer using the term ESG. So is that why investors are pulling some of their funds away from that space? BlackRock's first chief investment officer for sustainable investing joins us on the other side.
question was, can the Biden administration unilaterally, or really any administration, forgive federal student loan debt under the HEROES Act based on an emergency, national emergency, in this case, COVID-19 being the national emergency there. And the question was, could they do that without approval from Congress? And this court here saying no in a 6-3 decision that goes back into repayment in September. So those payments are going to have to be made, or other arrangements to apply for other forgiveness plans. But this particular debt relief is off the table. There has been so much talk about the potential impact on inflation, that this could compound problems here in the United States with prices being so high, that now these borrowers are going to have to go deeper into their pockets and grab some money for student loans. And they've had this reprieve for over 2 years now.
Even the folks that we started with a plan when this was first announced, we obviously have been revisiting it in recent weeks in expectation of this announcement coming out. And now what we're in the process of doing is relooking at their situation, putting a plan together, looking at their budget to make sure that they're going to have sufficient cash flow to pay for these payments as they restart. The bottom line is, either way, these payments are coming and you have to be prepared to start paying them or pay off the debt.
This ruling by the Supreme Court is not a surprise. Clearly, the White House was prepared for it. I think this is a messaging win for Biden, to tell you the truth, because he can say to voters, elect me again in 2024, make sure Democrats retake control of Congress so we can pass this legislation so that the Supreme Court can't undo it again.
Investors are continuing to pull away from ESG funds amid growing concerns about a recession. Sustainable funds saw $15 billion in net outflows in the second quarter, according to data from Refinitiv. That was the 5th straight quarter of declines. That all coincided with the increasing politicization of ESG. BlackRock's Larry Fink, the world's largest asset manager, recently saying he's no longer using that term because, in his words, it's been weaponized. Joining us now is Tariq Fancy. He is BlackRock's first CIO for sustainable investing. Tariq, we've had this conversation about ESG before, but now that we have seen the political backlash, I'm curious how you've been watching it. Why do you think ESG, these funds, got to become so politicized? Like, how do we get to this point?
I think the way we have to think about it is to remember that ESG is practiced. It pretended to be about investing, but in reality, it was about marketing and PR, right? If it was really what the people, ESG advocates were saying, which is that we have a bunch of new data that's going to unlock additional returns, I don't think it would get politicized because it'd be fairly objective. And, frankly, Republicans like making money too. But the reality is most of what actually constituted ESG were marketing and PR strategies. Think of a firm like BlackRock. Most of the assets are passive. So, you have marketing and sort of distribution teams driving it, and they find, a bunch of areas that probably aren't that linked to return, but they do sell very well with progressives. And that way, if you kind of look at ESG funds, you'll find that the thesis almost always aligns with one side of the political aisle. Right. So E can be objective, but a lot of S issues in ESG are not. And you'll never find an ESG fund that says, diversity is not good for returns, even if there's evidence to say that, because at its core, it's kind of a price segmentation strategy to address progressives. And it grew during the Trump era when progressives were looking for ways to use their dollars to make a difference.
Yeah, I mean, so much of the concerns were about the guidelines for determining what is E, what is S, and what is G. You've talked before about the promise of ESG. You make the world a better place, you get better returns, and then asset managers get more in fees. Now that those returns aren't good, is there a case for investing in ESG right now?
There's not in its current form. There is in a reconstituted form. So the way to think about it is if this actually started with investors, there's no way that they would mash together a whole bunch of things that are unrelated and into one single score of uncertain weighting with some of them hard to measure. You just wouldn't do that because, frankly, the underlying data is more important. And so I think what we've at a place now where ESG as an industry has produced some good things, right? There's a lot of passionate people around it who understand these things well. There's better data, there's better reporting and standards, but it needs to get to a place where we're actually focused on investing first and not marketing. And if you actually look, I mean, there are a lot of areas where businesses can actually become far more efficient. They can optimize their uses of inputs. They can implement reuse economy approaches and frankly, just, get more out of less that are inherently green, right? They improve profits and they also reduce their environmental footprint. And those are not politicized at all. But, I think that's where ESG, probably not to be called ESG anymore, is going to move. And I think, there's a lot of interesting strategies in that area. But I think the historical ESG, where you just take a grab bag of stuff that progressives care about and you try to sell it to them, and its corollary now, which a bunch of anti-ESG funds being sold to the right, those don't produce any investing value. That's just a price segmentation strategy for commoditized products. And we're unfortunately seeing that, happen across commoditized products in the US today, because political polarization is so high that there's a Starbucks and then there's Black Rifle Coffee on the right, which adds a machine gun in its logo. I mean, it doesn't really help anyone, right? But it does give an opportunity for companies to exploit that polarization so they can sell, commodity products.
It feels like the problem has also been so much of ESG has been conflated with actual climate action. And those are two very separate things. If we're talking about the E, the environmental concern specifically, I mean, are capital markets an effective tool in creating change on that level?
I think capital markets and capitalism are by far the best sort of mechanisms we have to address these challenges. I think the question is how that comes about. The markets need signals from government in order to change their incentives in the way they value the natural environment. So, for example, if we have a tax on pollution, right, which someone won a Nobel Prize in 2018 for saying, and that's based on work from the last century, that gives a signal to markets, so more capital goes to renewable resource and other things. And so I think the question is that the markets can do what we want them to do, but they can't do what we want them to do if there's a market failure and we ignore that it exists. And I think a lot of Wall Street is afraid that actually addressing these problems means taking an economic system that is far too focused on the short term and making it actually care about not exploiting the environment in the short term, not doing a whole bunch of things that are not in the public interest. And I think that can happen. But I think we need to have a more honest conversation about what it entails, because it's not at all uncapitalist to say that markets need rules to change incentives any more than it would be to say that, is it anti-basketball to say that we need to have referees, enforcing rules? Not really.
So how do you ultimately create impact through investing? If you are an investor, it is about trying to reduce emissions. It's trying to address the concerns about climate change. How do you do that through investing, and how do you measure the impact?
I think, it's an interesting question. I think that you can either do it through private investment vehicles that, by definition, provide fresh funding to innovators. So a lot of climate tech VCs and impact PE firms can actually claim that they're creating impact that would not have otherwise existed. In the public markets, it's much more dubious, right? The original mechanism was that you divest. I mean, divestment is a waste of everyone's time. It's cancel culture meets financial markets. It doesn't change anything. Now people are talking about engagement. Right. But the reality is, I started my career as an activist investor. I mean, I learned to invest in Carl Icahn's former CIO. Activist investing in the public markets can drive change faster than would otherwise occur. And that's what is called additionality or impact. But for the most part, your question is a good one, because most of what's happening in public markets, you're not actually changing anything that was already going on. And the illusion that we may be is actually concerning, because it is justified a bunch of fee bumps that don't need to exist. And it's also, wasting precious time.
What we have seen in public markets is this push for additional disclosures around climate impact, whether that is about a bank and where they're investing, whether it's about disclosing the vulnerability of supply chains. I mean, I know when we've spoken in the past, it sounded like you weren't exactly, not necessarily on board, but you didn't think that was an effective thing to target. I mean, I'm curious how your thought process has evolved around disclosures, and should companies be forced to disclose more?
I think in general, if there are material areas to a business, whether it's ones that we care about politically or not, but that could actually affect the value of that business, then I think it does make sense to have them disclose it, because any reasonable investor, Democrat, Republican, or otherwise, would need that information. But I do think that there's a concern I have that focusing on disclosure alone doesn't actually change the system. Like, transparency is necessary, but not sufficient, because ultimately a lot of the exploitation that's going on of the environment is because the incentives are to do that. So if all you do is you have greater disclosure, and now we see who the worst emitters are, does that change anything? I mean, the worst ones will face some public pressure. If they don't have a consumer-facing brand, they might go private. They'll get bought by, someone. I mean, there's actually news stories of some guy, Czechoslovakian guy, who seems to have created a fortune of 17 billion from buying dirty assets that are being sold by public and other players. And so disclosure is useful, but it's not enough on its own, because just seeing that there's something going on that you don't want to go on is not the same as regulating it or changing the underlying incentives, right? Again, if this was a sport, we want to disincentivize dirty play, but disclosures like adding video assisted referee or VAR, right? What they call in European soccer, because you can see what's happening in slow motion closely, but you still need a referee to give out a red card, right? And that's the piece where we can't seem to get past where we are, because the politicians don't seem to understand how to actually enforce sacrifice and get reelected. And they're kind of pushing the ball over to saying, oh, Larry Fink and Jamie Dimon have got this. And they clearly don't have any particular answer, that aligns with the public interest. And I think the sooner we recognize that, the better.
No question, it's going to be an ongoing conversation. Tarek Fancy, always good to have you on, founder of the Rumi Initiative and also former CIO for sustainable investing at BlackRock.
Thanks.
Well, coming up, President Biden announcing a new clean energy initiative today. But what does that mean for his re-election chances? We're going to have more on Bidenomics when Yahoo Finance returns.
Majority of small business owners say that their business is exceeding expectations, with 71% optimistic about the future despite economic challenges. This according to a recent JP Morgan Business Banking Sentiment Survey of small business owners. Well, here with a closer look, I want to bring in Ben Walter, CEO of Chase Business Banking. Ben, it's great to see you. So these findings were a little bit surprising given the current macroeconomic environment right now. Small businesses are feeling very optimistic. What's driving that?
Well, it's interesting. We bank 4 million small businesses, and we survey 500 of them every month to find out how they're feeling about the economy. And we always see a little bit of a disconnect. So we always see, if you ask any small business owners, they say, my business is doing pretty well. It's doing just fine. And part of that is just being a small business owner. You have to be an optimist. But over the last few months, what we've seen is a wider divergence than we normally see of people saying, my business is doing great, but the outlook out there, it's pretty lousy. And that's where people were for the beginning of the year. And a lot of that, you've heard the word vibe-cession, people not feeling so great, a lot of it having to do with inflation and the stickiness of it. What we've seen over the last few months is that gap is closed. People are now saying, actually, my business is doing pretty well, despite some of the things that people are saying about the economy. And I think it's going to continue to do well. So I think, a lot of the things that have been going on in the economy that were sort of new, people hadn't seen inflation for a generation, people hadn't seen labor shortages for who knows how long. Now people are kind of getting used to it. They're adjusting their business models and they're feeling like they can do well despite those things.
Yeah, it's interesting to hear how that divergence, or at least that divide, has closed. And you wonder how much of that is actually a harbinger of what's to come beyond small businesses. What about cost pressures, though? And how have they been able to navigate that? And how has that affected sentiment, especially among small businesses?
Sure. I mean, at the beginning of the year, it was weighing on them hugely. They certainly still are dealing with it. If you look at small business, if you ask small business owners what's going on, 37% of them say, inflation's still really a problem. But that's still less than half, right? So there's still a majority of them who are saying, I can deal with this. And a majority, you have you have the number up there, a majority say they are going to raise prices. When you talk to small business owners, and I'm lucky enough to talk to lots of them every month, when you talk to them, what they say is, I'm still probably going to have to raise prices, but a lot less than last year. And that's for a couple of reasons. One is they're seeing their prices go up more slowly, and you've seen that in the macroeconomic data. And the other challenge they're having is they're coming up against their customers' ability to pay. And that's particularly true the closer you are to a consumer business, the more you're running up against that ability to pay. So the more you're starting to constrain your price increases, and that will eat into margins. But we think there's enough room for that to run. The other numbers you just put up have to do with labor shortages and supply chains. Again, those are things that really spiked during the pandemic. They've come down, but they're still out there, and they're persistent. And that's why I think you're hearing people talk about persistency of some of these challenges. It's why you're hearing people talk about the Fed holding higher for longer. These things are real, and they're not just going away.
Ben, how are they adjusting or really dealing with the labor shortage? Because it is a massive issue. Are they being forced to offer higher pay? Are they being forced to offer other types of incentives in order to get the workers that they need?
Yeah, I think there's a few things. So pay has definitely gone up, and we see across the board they are offering higher pay. In certain segments, I hear lots of pleas to politicians to open up legal immigration. I'm not talking about illegal immigration. I'm talking about legal workers. Those numbers are down significantly. Anything in the hospitality industry is really feeling the pinch from that. So they're begging for the doors to be opened back up to get some more workers in the door. That's one of the angles. They've gone to non-traditional sources. So you hear, how many people have you heard in general about switching careers and finding new things to do? They've gone to non-traditional sources to find new sources of employees and to hire up. And then they're just making do with less. A lot of them are getting smarter. So a lot of the efficiency plays that people have sort of been holding on to for a while, they're now putting them in play. So they're trying to automate with software, they're trying to modernize, and they're trying to figure out how they can squeeze more through with less.
So Ben, that leads me to my question, which is, it's great that businesses are feeling good, that sentiment is positive. Have they increased their investments as a result? And if so, where is that going?
Yeah, they have increased their investments overall, but it's very industry to industry. So if you look across the industry, software, investing heavily. Professional services, investing heavily because they see the returns. Consumer businesses, less so. Hard investment, capital investments, starting to slow down. So it's a real mix in terms of industries and where people see demand. If you look at the industries that are most resilient, though, they're going to keep powering through, and we see continued strong investment.
Ben, the turmoil in regional banks, obviously a massive concern going back to March. Is that how worried are the small business owners that you're talking to about some of the fact that maybe we could see some more pressure when it comes to lending and what that means for their business then going forward?
I mean, if I try to be a little cynical, I hope they're not, our customers, we hope, are not too concerned about it because they happen to bank with us. However, we do, but many small business owners do bank with multiple banks and go to multiple places for sources of credit. And we certainly hear pressure about, will it be harder for me to get the capital that I need to run my business? So I don't know that you've quite seen the pinch hit the ground yet, but there certainly is concern about that. We are hearing talk about tightened lending conditions across the industry. At JP Morgan Chase, we lend through the cycle. So when things get rosy and everything looks good, we don't tend to lend more. And when things look tighter, we don't tend to really squeeze it down as much either. So we try to lend through the cycle and be there for our customers all the time. A lot of other banks do too. Other banks are feeling a squeeze. And so you'll see a mix of outcomes out there. But access to capital is always an issue for small business owners. And if you do see a real crunch in that, that's going to put the pinch on them.
Ben Walter, great to have you here, CEO of Chase Business Banking. Thanks so much.
Thank you.
President Joe Biden speaking in South Carolina today, highlighting a $60 million investment from solar manufacturer Enphase Energy. The deal will help create thousands of jobs, new manufacturing lines, and power as many as 1 million homes per year with solar. Take a listen to what President Biden had to say about the future of clean energy in the U.S.
Just today, the Department of Energy announced new incentives for companies to bring solar power manufacturing back to our shores. We're in a real race. China's ahead of us. This is another step in helping us meet the goal of 100% clean, renewable energy electricity by 2035. By 2035, all electricity in America is going to be generated by clean energy.
For more on what this means for the president, let's bring in Yahoo Finance's Rick Newman. Rick, it certainly feels like the White House has decided to double down on the president's economic policies, despite what the sentiment may be about the direction the economy is headed in. How does he turn this into a winning message?
I think he keeps going to every city in America and saying it over and over and over again, and hoping people begin to associate all the laws that Biden has signed and all this money that the government is now beginning to dole out in incentives and tax breaks and other things like that, that they begin to associate this with low unemployment and with falling inflation. The problem that Biden has had is he's had a lot of legislative successes, 3 major bills he signed that are now putting a lot of money into the economy for semiconductor manufacturing, as Biden was saying there, solar panel manufacturing. A lot of this is going to be electric vehicle batteries and associated components and things like that. This money is just getting started, but voters are not giving Biden any credit for this boosting the economy. And I think part of the reason is it's 2 things, probably. First of all, this money is just beginning to flow into investment. We're talking in South Carolina about we don't even have the groundbreaking of a factory. But that is going to be a factory. It is going to create jobs. So it hasn't really shown up in the real economy yet. And then, of course, people are still gobsmacked by inflation. So people need to get over the shock of inflation as inflation comes down. And I think we're going to see Biden basically going around the country for the entirety of the presidential campaign, which means for another 16 or 17 months, basically saying the same sorts of things he was saying in California today, because he just has to hammer this message in order to get people to give him some credit.
Well, certainly, Rick, there has been some pushback among GOP, specifically Senator Tim Scott, one of the presidential candidates that Biden is going up against, criticizing some of this rollout here and what exactly the president should be focused on. How does the president, or how has he responded to that? And what does that really signal just about what's ahead here for the coming months?
Well, it's kind of fun because one of the things Biden is doing, maybe to try to get a little bit more media attention than he might otherwise, is when he goes on these trips around the country, he highlights Republicans who opposed the legislation that is now pushing money into these districts all across the country and helping to create some jobs. So he pointed out several South Carolina politicians, all of them Republican, obviously, including Senator Tim Scott, who voted against the infrastructure legislation from 2021, voted against the CHIPS Act in 2022, voted against the green energy incentives in 2022. That's where this money is coming from. And this money is, we're now getting some credible studies that say this is actually going to put a lot of money into red states and red districts and help create a lot of jobs there. So Biden is not shy about calling out what he would call hypocrisy among people who say they were opposed to these things when it was up for a vote, but they're quite glad to have the federal money and they're quite glad to have any jobs this would create. This might get better for Biden. Again, the biggest problem for him is inflation. This is the most effective thing Republicans can ding him on. It's now down to 4%, but that's not low enough, and consumers are still paying elevated prices for a lot of things. That needs to come down, I think, for this message to get through and for Biden to have a good weapon against Republicans who are going to keep hitting him on that.
We'll see if that positive spin sticks come next year. A long way to go. Rick Newman, thanks so much.
Bye, guys.
Well, coming up, the closing bell on Wall Street. We're going to get you caught up on today's market action and take a look at some of the stocks that finished the day strong. Stay tuned.
And that closes out today's trading action. All three of the major averages under pressure following that very strong ADP report before the bell. The Dow closing off its lows of the day, off just around 365 points. S&P off about 0.8%, as well as the Nasdaq. Let's take a look at some of the trending tickers. The top one on Yahoo Finance today, Affirm, the stock sliding roughly 10% after a downgrade to underweight from neutral at Piper Sandler. The analyst there citing higher rates, also the restart of student loan payments as a couple of headwinds here facing Affirm. He also talked about, Akiko, some competition. We know Apple Pay Later, the new entrant into that space, bringing up some questions just about their ability to attain that revenue growth that they've laid out in terms of their forecast.
Yeah, competition, a big one, but higher rates, you could argue even bigger when you think about the impact it's likely to have on Affirm. The analyst specifically saying that Affirm relies on loan sales to drive a huge part of their revenue. And if you look at where the company is right now, they've increasingly held on to some of those loans on their balance sheet. With higher rates, that's an even bigger concern. And you see that downgrade today reflected in the stock, at least down about 10.5%. We are also watching Microsoft shares, the top performer on the Dow today. Morgan Stanley raising its price target on the stock, naming it a top pick in large cap software. Behind all of that, of course, optimism in Microsoft's AI exposure. We're talking specifically about OpenAI, ChatGPT. By the way, Morgan Stanley increasing their price target by roughly 24%. Huge upside there. They say specifically that Microsoft is poised to top a $3 trillion valuation in early 2024 because of the big bump they're getting from AI.
Yeah, Kiko, they're not buying the fact that there's some concern out there that Microsoft is overvalued at this point. Lots of concern about whether the AI hype has been overdone. They're really reiterating the fact that they believe that Microsoft is a leader in this space. And what's driving that narrative, this is a team led by Keith Weiss, is that they're best positioned in software to monetize some of the expansion that they are expected to see as the automated workflow that's a result of generative AI. So we talk about the fact that generative AI is going to disrupt jobs and how people think think about jobs and do their jobs. Morgan Stanley making the argument that Microsoft is best positioned to capitalize on that. We know, obviously, Microsoft has been really pushing even further into the AI space, working it into various parts of their business, overhauling their entire lineup of Office apps. So Morgan Stanley thinking that they are going to remain the leader in the space, at least for now. All right, also keeping a close eye on shares of JetBlue, the company announcing that it's going to end its alliance with American Airlines in the Northeast. JetBlue saying that it will focus on its acquisition of Spirit, so a bit of a shift here from the airline, not necessarily a surprise. We know they have been really focusing on Spirit and what exactly that's going to do for their business going forward. A 7% drop, though, in the stock today, Akiko, one of the biggest drops that we've seen, and biggest intraday drop since March.
Yeah, I'm a little surprised by the drop because, to your point, Shauna, so much of this and the potential for that alliance coming to an end came up during the whole acquisition talk and whether, in fact, JetBlue was finally going to acquire Spirit, which they did. You know, you could have argued that was kind of priced in, but I mean, I guess at least if you look at right where the stock is right now, pointing to potentially a bumpy road ahead.
Yeah, there's some optimists out there. They were holding on to hope. They didn't want to buy the headlines, but certainly we are seeing a sell the news type of reaction today. All right, well, after a huge windfall during the pandemic, many investors are eagerly awaiting to find out what Pfizer's next move is going to be. It's currently going through a $43 billion deal with Seagen, but following that, could shareholder benefits be on the table? Anjali Kamlani following the story for us. And Anj, what can we expect?
Well, Shauna, that last part is exactly what shareholders are looking for. Some sort of benefit from this windfall. Questions about what the pipeline looks like for Pfizer. They've really had to prove their mettle when it comes to this M&A activity, in particular Seagen with that big deal, but then also looking at beyond that. And it's something that really has actually been on the mind of both Pfizer and its CEO for quite some time. So a recent Goldman Sachs analyst noted that after the Seagen deal, quote, management would look to increase the extent of capital they return to shareholders through both share repurchases and greater dividend increases relative to prior years is something that they're looking for, discussing with management as well. Meanwhile, we've had conversations with Pfizer CEO Albert Bourla just about the stock and how shareholders have reacted. We know that it's one of the only companies that didn't necessarily benefit stock-wise in the same way you saw other competitors like Moderna and Novavax and J&J get a little bit of that boost during the pandemic. Pfizer stock has tended to stay within a certain range. And so that hasn't really changed even after all these deals, even after the tens of billions of dollars in the COVID windfall. So it really is interesting to keep an eye on. We've heard him, Pfizer CEO Albert Bourla, tell us, quote, the multiple that is assigned to our stock is bottom of the range. He's been frustrated by the reaction from the stock market in the past. But what I remember, back in 2019, prior to the pandemic and prior to any of this happening, was when Pfizer was really looking forward to being a leaner, greener machine, really focusing on innovation, peeling back on its generics and its consumer business with Upjohn and that spin out. And so I remember him saying, quote, that the company will continue to have financial flexibility to invest in growth while returning capital to the investors. So those already on the table. And it seems like just a matter of time on when this timeline could happen and when, the shareholders can get an answer to this question, because Pfizer is certainly sitting on a lot of cash right now. They are making moves and they do have to boost their pipeline because of the patent cliffs that they're facing. And so after that, maybe that conversation happens. So something we'll be around to, of course, watch and report back.
Yeah, shares off over 30% in the past year. Right, Anjali Kamlani, thanks. Well, coming up, a potential turnaround when it comes to jobs in the tech sector. Which area of the industry is seeing some gains, seeing some postings? We'll discuss on the other side.
The question was, can the Biden administration unilaterally, or really any administration, forgive federal student loan debt under the HEROES Act based on an emergency, national emergency, in this case, COVID-19 being the national emergency there. And the question was, could they do that without approval from Congress? And this court here saying no in a 6-3 decision that goes back into repayment in September. So those payments are going to have to be made, or other arrangements to apply for other forgiveness plans. But this particular debt relief is off the table. There has been so much talk about the potential impact on inflation, that this could compound problems here in the United States with prices being so high that now these borrowers are going to have to go deeper into their pockets and grab some money for student loans. And they've had this reprieve for over 2 years now.
Even the folks that we started with a plan when this was first announced, we obviously have been revisiting it in recent weeks in expectation of this announcement coming out. And now what we're in the process of doing is relooking at their situation, putting a plan together, looking at their budget to make sure that they're going to have sufficient cash flow to pay for these payments as they restart. The bottom line is, either way, these payments are coming and you have to be prepared to start paying them or pay off the debt.
This ruling by the Supreme Court is not a surprise. Clearly, the White House was prepared for it. I think this is a messaging win for Biden, to tell you the truth, because he can say to voters, elect me again in 2024, make sure Democrats retake control of Congress so we can pass this legislation so that the Supreme Court can't undo it again.
The tech sector has seen mass layoffs over the last year, but there's one area in the industry where job postings are rising. Let's bring in Yahoo Finance's Ali Garfinkel. Ali, I'm going to take a wild guess and say it has something to do with AI.
It absolutely does, Akiko. But before we get to AI, I think it is really important to say, generally speaking out there, it's pretty brutal if you're looking for a job in tech. Absolutely everyone I've talked to has said that there is less hiring across the board in tech. You know, that means fewer onboardings. That means a lot of recruiters out of work. That means fewer job postings. And this does track with the raw data, right? Tech layoffs have been a huge story over the last year, and they've been an even bigger story this year in a lot of ways. We are halfway through 2023, and we have seen more tech layoffs this year than last. That being said, pockets of optimism. They absolutely do exist. Tech talent is definitely still in demand. It's just not necessarily at tech companies. For instance, I had a source tell me that he is hiring a lot of developers at healthcare companies right now. The other thing, too, is that geography is playing a role. For example, U.S. tech talent just doesn't have the same level of opportunity that tech talent in Central Europe, Africa, India has right now. And then, of course, the moment you've been waiting for, Akiko, AI. That is the one area where job postings are up, hiring is up. There's something that people are calling an AI premium actually in the job market right now. And there's some stats to back this up. For instance, the average salary for a software engineer specializing in AI is 12% higher than for those who don't specialize in AI. Add to that, there's also been a 4% increase in salaries for those AI engineers since the beginning of the year. So all in all, it isn't a great picture for tech workers right now, but there are bright spots, optimism flooding in from the broader labor market. We saw those ADP numbers today, 500,000 jobs almost added in June to the economy. And I think it's maybe more important than ever to say it's really clear that tech jobs aren't just at tech companies anymore. And I think that's where you're going to see the most of the tech hiring activity, at least for a while.
Yeah, we've heard a lot of stories about government jobs. Really, they are trying to recruit a lot of tech workers too. So there's certainly a lot of recruitment going on for some of that talent. Ali Garfinkel, thanks so much for that.
The share of workers rating their retirement savings remains at an all-time high as they grapple with the lack of emergency funds. We have Yahoo Finance's Carrie Hennon here with the details on that. Carrie, what are we seeing?
Yeah, I mean, this is a gigantic problem that we're seeing as workers are dipping into these retirement accounts and they're just withdrawing the money. We've seen this. The most recent study was Transamerica that we're looking at this week that found that, a large percentage of workers have dipped into them, mostly younger workers more than older workers. But we've seen this same trend through Vanguard's recent report. Bank of America has shown this. This is definitely a trend that's happening, and people are dipping into these accounts and they're withdrawing the money and they're willing to pay the tax on that money as well as a possible penalty. But what has happened is what we're seeing is this report from Transamerica really is showing that people need the money now. They are saying that they're having trouble making ends meet, that they simply don't have the income to continue to save for retirement. And they have these big medical bills. It's not like they're using this money frivolously. These are hardship withdrawals. They're looking to pay medical bills, preventing an eviction from a home or other home costs, these sorts of very serious issues that people are confronting. But I've got to tell you that this kind of drainage on retirement accounts is going to be something that people really feel in retirement. And it's concerning. I mean, there's just pervasive pessimism out there when Transamerica looked at the workers in general who are withdrawing this money and the others. It's inflation that's causing this problem. It's, what we've been going through, the strained budgets. But people, you ask them and they say in this study, they said most of them feel like, a large percentage, 4 in 10, say they're going to be worse off in retirement than people who are currently retired. Their number one fear is they're going to outlive their savings. And if they're dipping into it, I can assure you this could be a possibility for them. And so this is something that we're grappling with. And both policymakers and financial planners have got to take control of this, because this is going to be a very bad situation. It's a very fragile situation. And when you look at retirement security, if people are opening the gates, and one reason this has happened is because during COVID, it became a lot easier to access this money. You could get to your retirement accounts to make a COVID-related withdrawal without paying that 10% penalty. And people have gotten used to this idea, and new things coming up next year with Secure 2.0, a law that went through last year, is trying to encourage people to save in retirement. But by doing so, they gave some new ways, new exceptions for people to be able to get their money back out easily. So will this compound the problem? It may very well. We may see more of this in the future.
Carrie, that raises the question about how people should be thinking about their emergency funds. How much should they be setting aside?
Yeah, this is a great question. And Kiko, what's happening is people have very small amounts of money set aside for in their emergency savings funds. In the Transamerica report, they found that, say, Gen Z has maybe $1,000, and millennials, maybe they have about, it looked like they had around, I think it looked like it was, they had around 5,000 set aside, but there's just not, or 3,500, 5,000 for Gen X. That's not a lot of money when you have a big medical bill, right? So what is happening is we're trying to find ways to encourage people to set money aside in these rainy day funds, right? One way that we might see some positive movement here is next year, because of Secure 2.0, there is a provision that will allow employers through the retirement account setup to automatically start these emergency saving accounts for their employees. It's a small amount, maybe 3% of their income, and you can opt out. You don't have to do this. But because of the auto enrollment in an emergency savings plan, now this is money that is after tax, but the good news is, it's this inertia. It's out of sight, out of mind. If you start automatically saving, trust me, this is a great way to get people started on that path.
Yeah, you got a lot of viewers thinking now about that potential for emergency funds. Carrie Hannon, thanks so much.
Thank you.
Well, coming up, we go around the horn and check in on some of today's top trending stories. Stick around.
Welcome back to Yahoo Finance. I'm Brooke DePalma alongside Pras Subramanian and Shauna Smith. We're taking a closer look at today's top trending stories. I'm taking a closer look at Sweetgreen. Shares surging today after the stock got an upgrade from Bank of America from neutral to buy. The firm also raised its price target to $17 a share. Key levers include automation, an increase in visits, and potential for higher digital sales mix. That drove Bank of America's decision for that upgrade. Now, in addition to that, taking a closer look at automation, they do have that new pilot in Naperville, Illinois. They said that it shows meaningful opportunity for the chain to narrow the profit margin with its big rival, Chipotle. In addition to that, we're also seeing visits up. Many investors on the street worried that since it has such a large urban presence, that delay to the return to the office would impact that visits. But now we're seeing that change a bit.
Yeah, we are seeing that change a bit. Certainly, we have seen the stock take off since the start of the year. Really, a lot of those gains coming within the last month and a half or so, as we have seen the share price skyrocket. It was interesting to me, that line that you just read about Chipotle narrowing that leadership gap. It makes some sense to me, although I don't necessarily see them as a direct competitor. I almost think that Sweetgreen, people that go to Sweetgreen for lunch, I don't know if their other option out there would be Chipotle. Now they have Cava, that's also a publicly traded company in the mix that you would think would also be a competitor along those lines. But Sweetgreen certainly resonating with its urban customer base, a lot of their stores within the cities here. And as we see that return to office, more and more companies bringing back their employees, at least on a hybrid type of schedule. Sweetgreen, one of those companies that could benefit from that in this.
For sure. I mean, that lunch crowd, that lunch kind of like surge of people coming back from the office. But 46%, I think it showed that visits up year over year. That's a lot. I had no idea that Sweetgreen's traffic was up that much. But like you said, for me though, okay, Sweetgreen's a little expensive, right? And Chipotle is like almost like $5 cheaper per ticket for me. So for me, it's sort of, I don't see them as comparable at this point.
Right.
Whereas, I mean, it is a lunch option, but I just feel like I find that price point really high. Cava as well, price is very high. Lots of enthusiasm for the IPO, right? So maybe I'm missing something here. Maybe that's the new normal. People that are sort of returning to work, it's happening slowly. We're seeing the data come up with offices coming like 50% occupancy, kind of perking up a little bit higher. Maybe this is a good thing for Sweetgreen, but I find their prices to be kind of out of control.
And also just what that expansion plan looks like. They have introduced a loyalty program, which Bank of America mentioned in this note, Sweet Pass, which they think is really paying off and one of the catalysts here going forward. But in order to expand that base, given the fact that these salads are very expensive, and I think in a time in an environment like this where some consumers are pulling back on their spending, they're not necessarily willing to go out and spend 15, 16, 17 bucks on just a salad.
Yeah, but Bank of America also noting that they see a potential upside to that digital sales mix. I mean, with that loyalty program, they also have Sweet Pass Plus, they're calling it. It's $10 per month. It offers $3 off daily orders as well as other perks. And I think with that being said, if you are a loyal customer and you're willing to pay $10 off, that $3 could make the difference.
Well, I'm just thinking about how, it got my attention. I'm going to look into that. But the thing is that if you're already making me come back to work, why don't I spend $20 on salad? Like you're almost like
going
like
because
you weren't paying that money when you're working from home.
I know, it's so hard to avoid though in the New York City area. I feel like if you go out there, you're paying for a sandwich, you're paying for anything. You're at least the minimum seems to be 13, 14 bucks on lunch. All right, guys. One of the stories that caught my eyes today is some news out from Japan Airlines, and get this. They're actually offering a clothing rental service, or looking to lower what they're saying in terms of the packing, not carry as much luggage, reducing the weight of their aircraft. They want to cut down on carbon emissions. This began earlier this month on July 5th. You can see it up there on the screen. Only for Japan Airline passengers, only traveling to Japan. They laid out plans to do this for at least the next year. The basic rental, 3 tops, 2 bottoms, starting at $27. I think it's a great idea. I don't know how many people are going to take that risk and rent something that they've never tried on before when they don't have any sort of backup option while they're on vacation. But I do like the idea of this.
Maybe culturally it's something that I don't understand. Maybe this is something that they do in Japan, renting clothing. I don't know.
Rent the runway. What do you
that's exactly what I
was going to bring that up.
Another competitor
I'm going to bring that up. Hold on. So okay. How much CO2 are we really saving by not checking the bag into the cabin? I mean, If everyone didn't check bags in, then it'd be a significant weight saving, better fuel economy, all that stuff. I will say this though, I was reading that Rent the Runway has this thing called hotel concierge, where you can, I guess you can have the close into your hotel. That appeals to me. I think it more selection. You guys tell me it's more for women anyway, but that's more appealing, more selection. But 3 tops and 2 bottoms, like I'm gonna wear that for 2 weeks. I mean,
yeah, I also think just in terms of the details, how much how much say you get into what exactly the type of clothing that you're going to get through this service. They've contracted a third-party provider in order to do this service. So I think that's the question here going forward. But Rent the Runway has proven to be very successful here in the U.S. Yeah. I'm an avid user. There certainly is an appetite out there for the sharing economy, sharing clothes. So I like the idea of this.
They are pre-owned clothes as well. So similar model to Rent the Runway, it's existing clothes. But you can see here, Rent the Runway doing poorly today, down 7%, but shares are down nearly 40% year to date as well of Rent the Runway. But in addition to that, what I thought was quite interesting is that given that it is what you said, I think 2 pants and 3 tops, I mean, the likelihood of that not fitting me based upon my Rent the Runway experiences what worries me. And I think I'll find myself end up packing a bag in addition to this. It's a short trial period too for a non-frequent flyer to really get a pulse of whether or not it's worth it. And if that size will end up being right, or you just don't end up wearing it and go to the store anyway.
Yeah. Well, at least they're bringing awareness to trying to cut down carbon emissions,
100%.
starting this type of conversation. Maybe we'll see other airlines follow suit. I don't know.
You know, let me know. I mean, for a mom, what about your kids, right? Would that be good? Like,
it would be so nice.
Shows up with nothing for them.
Always leaves packing to the last minute, the night before a trip. I'm trying to figure out what exactly we need, running to CVS, running anywhere to get those last minute items. I love the idea, but exactly whether or not you're able to bank on the fact that these clothes fit and rely on it, that's the only hesitation I have.
And when it's like, I don't like this color, mommy. Right. Sticking with transportation, we're talking about Volkswagen here, signing a deal here with the city of Austin to actually start testing out autonomous driving there. They're gonna have a couple of these ID Buzz vans there at the end of the month, and they have 10 of these by the end of the year, geo-fenced in Austin. It's kind of interesting because they're in Tesla's backyard, because Tesla has their Gigafactory there in Austin. And also, this is VW moving on from their winding down of the Argo AI business that they had with Ford. They didn't see it as being financially viable, but then here they are testing out autonomous right now. So it's a bit of a mix up here. Yeah.
Yeah, Praz, what do you make of this? I'm curious for your perspective, given the fact that, they did wind down their investment in Argo. I think I also read that they're employing some of the former Argo engineers as part of this initiative, as they're looking to expand at least this side and as they try to test these vehicles. But the end game here, because it's not just about robo-taxis, right? They're looking to sell these in terms of for delivery services, but also some other providers as well, which could potentially expand that sort of business pool.
Yeah, like a total commercial offering as opposed to a consumer offering. You know, Ford is actually experimenting more with their Blue Cruise, which is like an assisted driving, not fully autonomous. So maybe, VW sees some benefit to going a bit further than that. But I just find it strange that they spent billions of dollars on Argo AI, wound that down, and I guess they hired some of those people, brought some of that tech on board, maybe doing it on a smaller scale. Maybe that's the play here.
Yeah, what also continues to worry about me about this concept of the autopilot is just the amount of crashes that we're seeing. I mean, last year in 2022, we saw 400 crashes of these vehicles. I think majority, if not most of them, were Tesla.
Yeah.
And so that really worries me. I mean, Austin is an up-and-coming city, and I just continue to think, I just cannot picture seeing that so many cars in New York City. I mean, between traffic and foot traffic alone, dangerous.
But there are people driving these cars, right? There's inhuman.
Someone is
these
behind
cars during the test drive.
I'm not sure. I'm not sure about this particular trial, but so there's Cruise, Chevy's Cruise, GM's Cruise, and also there's Waymo, Google Waymo, and they in certain cities don't have drivers there. Yeah, they're fully autonomous, geo-fenced in a certain area, so there is a control factor there. New York City is a whole other ballgame, right? That's just way too much going on. But in certain parts like South Congress and 6th Street and Austin, maybe it works. Maybe it works.
Maybe it works. We'll see what exactly Volkswagen has in store for this, but certainly an interesting story there, expanding their self-driving initiative in Austin, Texas. All right, guys, thanks so much for that. We got to leave it there, but coming up next, we're talking about Barbie, the movie set to hit theaters in just 2 weeks, and the hype is certainly real thanks to all that viral marketing. We're going to discuss more on that when we come back.
Hey, Barbie. Can I come to your house tonight?
Sure. I don't have anything big planned, just a giant blowout party with all the Barbies and planned choreography and a bespoke song. You should stop by.
So cool.
You can find me under the lights, diamonds under my eyes.
This is the best day ever.
It is the best day ever. So is yesterday, and so is tomorrow, and every day from now until forever. Do you guys ever think about dying?
Mattel's hotly anticipated Barbie movie comes out in 2 weeks, and the hype around it, well, it couldn't be more real. The movie has an estimated $100 million budget, according to Variety, and is tracking for an estimated $70 million plus opening. Well, the excitement started over a year ago with Mattel's release of this image right here of Margot Robbie as Barbie. And from there, well, fans certainly got lost in the pink, glittery Barbie world. 2022 was the year of Barbiecore, a fashion trend spotted on Valentino's runway in the fall and also embraced by a number of celebrities, including Lizzo, Anne Hathaway, and Zendaya. Well, hashtag Barbiecore has over 420 million views on TikTok, and the marketing is everywhere. Mattel released a line of Margot Robbie Barbie dolls and has apparel collabs with Gap, Forever 21, and Hot Topic. Bloomingdale's is doing a Barbie-themed pop-up shop. Well, that is not all. A luggage collaboration, custom Xbox controllers, a makeup collection, Uno cards, and Aldo shoes. Progressive getting in on the fun with a commercial about insuring Barbie's dream house. And Barbie's house is even up for rent on Airbnb. Well, we decided to get out on the streets in New York City and see what people think of the movie's marketing techniques.
The marketing is amazing. I saw the little Ken house Airbnb. I love that. I think the marketing was awesome.
I like the marketing. It's a little, cheesy.
I've seen a lot of marketing about it. Even like this Barbie and Ken thing they have going on the billboards. It's really? It's pretty out there, man.
We're staying in Times Square, so we see the big billboards with all the pink and all the actors and actresses. The marketing is pretty epic.
I just feel like I've been inundated with Barbie stuff. Okay. I'm almost over it, and it hasn't even opened yet.
The marketing, like the ad with her foot up, that's what got me for real.
Well, let's talk more about this viral marketing campaign. We want to bring in Marcus Collins, University of Michigan Ross School of Business marketing professor, also author of For the Culture. Marcus, it's great to have you here. So even just what we're hearing from people on the street, it almost seems like everyone has heard that the Barbie movie is hitting theaters in just 2 weeks. What do you think it is about this marketing technique that has made it so effective?
I think that, one, they've borrowed on the equity, the capital that is Barbie. And this is a well-known, well-beloved brand that's now being contemporized, which is actually really cool. But I like the way they brought the brand to market by marketing the movie like it was a Disney movie, right? They find all these different partners that could benefit from the movie winning, right? You find compliments, the peanut butter to their jelly, if you will, that if the movie does well, these other brands do well. And finding different cultural aspects that the movie could be a part of the conversation, the cultural discourse, will create much more opportunity for people to find out about the movie, and hopefully for the brand at least, people to know more about the movie.
Marcus, how much of this though hinges when you talk about the potential success of it all? Does it hinge on people actually going out and watching the movie? Because as you pointed out in your notes, like there could be a lot of hype, there could be a lot of interest, but if that doesn't translate into people going into the theaters and watching this movie, what does it ultimately mean?
Yeah, I mean, this is sort of the double-edged sword, that sometimes the marketing be so good that it overshadows the movie, that people get so enamored, so excited about the marketing for the movie, they never show up at the theater. And that's the part that gives me a little bit of pause when I think about the excitement that's happening around all the marketing for the Barbie movie, is that there's a lot of talk about how cool the marketing is, how it's showing up at all these different places, yet I haven't heard a lot of the discourse in the social channels, at least, about people saying, I can't wait for it to come out, I've already bought my ticket, I'm so there, who's going with me? There's not a lot of intent signaling. In fact, if you look at Google Trends, the search traffic, a lot of the search queries are about all the marketing partnerships, not about the movie per se. And since the core product is the movie, that should draw a little bit of pause for the folks who are putting this thing in the world.
Marcus, Have you seen this much excitement around a movie like this? I know you drew the comparison to what we've seen from Disney movies, but I'm scratching my head. I'm struggling to really think of another movie that has gotten this much attention, this many brand partnerships ahead of its release. Is this almost unheard of?
You know, it happens rarely outside of Marvel movies and Disney movies, which is Disney, of course. But I think about the last time I've seen something at this kind of capacity, this kind of fidelity, would probably be the Stranger Things season 3, I think that was, when they partnered with all those different brands like big Burger King, Baskin Robbins, Lego, Microsoft, Coca-Cola. All these brands got into the launch of this new platform. I think that's the last time I've seen that outside of a superhero movie or a Disney film. But even then, when we see these brands work with movie releases in this way, they don't always mean success. I mean, most recently, look at the Buzz Lightyear film that came out just recently. They had a lot of traction behind it, a lot of different brand partnerships. It was on cereal boxes, it was in McDonald's toys, but they didn't convert into actual ticket sales. And that's what we're after. How do we turn all of this cultural conversations, how do we turn it into intent that ultimately leads to action?
The movie aside, though, there's also the question about what this means for Mattel, the brand, and their ability to be able to connect with potentially a newer generation and get that runway going or extend the runway for Barbie. Our Brian Sozzi and Brad Smith sat down with Mattel's COO earlier, asked him about how important the movie is for the brand beyond dolls. Take a listen to what he had to say.
The next chapter of that is going to be unlocking the value of this IP through storytelling, whether it's theatrical, television, live action content, gaming, live experiences, all of the different category partnerships that we've created in consumer products, where this movie is really a catalyst for future monetization in the consumer product space, apparel, sporting goods, home, accessories.
So, Marcus, that was a conversation over at Cannes Lions, but can Mattel build on this? Can they already claim this as a win, just given how much they've already made, the brand's made its way into the conversation?
Oh, absolutely. Mattel has definitely won in this regard. It reminds me of the music industry, that nowadays people release albums so they can go on tour. And in this way, Mattel releasing this movie, whether it succeeds at the box office, it's a master, a mega success or not, the fact that it has contemporized the brand and introduced it to new people who weren't even thinking about or talking about Barbie is definitely a win for the IP. It creates a new canvas for it to draw and to create new ways to engage with the brand, as the COO mentioned, whether it's through product, whether it's through more toys, whether it's through more movies, through gaming and the like. I mean, the possibilities are endless now that it's creating a new chapter for people to see the world of Barbie. Barbie is now has a new cultural lens to it. Now, whether the movie is a success or not, it still benefits from that win.
Marcus, what do you think we're going to see moving forward when we take into account some of the other legacy brands out there, some of the lessons that they can learn from this Barbie revival? How does that shape, do you think, future marketing campaigns?
Well, it's all kind of creating a blueprint, right? For the ones that fail, you go, I know what not to do. And the ones that succeed, you go, I know what to pick from that. But I think what ultimately matters when we're bringing new ideas to the marketplace through marketing communications, it requires some familiarity and some novelty. So we can borrow from things that worked in the past and create new builds on top of it. I mean, even the AI generator, meme generator that Barbie used back in April, I think that was, we saw that happen with Straight Outta Compton for the biopic for NWA happened some years ago. Same idea, but a new wrapper, a new lens on it. So when we pair familiarity with some novelty, it creates a great opportunity to get people's attention, but ultimately get people to talk and then prayerfully get people to take action.
Marcus, you just queued up the segment nicely for us when you talk about memes. We couldn't do this segment without getting in on the action. So can we pull that up? There's one for me. Look, Shauna is, what is this? This Barbie
I'm hitting the dance floor.
And mine says this Barbie is an optimist. I'd say that's pretty accurate. Have you made your meme, Marcus? Have you played around with this one?
I made my meme. I did make my meme. It said, this Barbie is all smiles.
Oh, there you go. There you go. Perfectly done. Marcus Collins, it is great to talk to you today. We'll all be watching to see if the success translates to success over at the box office. Thanks so much for that.
Absolutely. Thank you.
Well, from the field to the booth to the brewery, Pro Football Hall of Famer and former Dallas Cowboys quarterback Troy Aikman has made a name for himself in the sports world and is now looking to do the same in the beer industry. Aikman sat down with Yahoo Finance executive editor Brian Sozzi to discuss the success of his latest business venture. Take a listen.
It's been a hectic year and a half for sure, but a lot of really good things have happened. Last year, of course, when we launched, we had some projections. We surpassed all of those. We hit some real milestones for us. We sold over 100,000 cases. As you know, we're only in the state of Texas. And for an independent launch, we were the #1 in the history of the state. So a lot of things to build on here as we move into year 2 and we continue to work and traverse the state. And a lot of good things are happening. So excited about it.
I'm a bit of a foodie, and I think I told you at the time, the can is cool, the brand is on the mark. This is something you're backing. I've tasted the beer; it tastes good. When are you getting out of Texas? When is that big expansion plan for this?
Yeah, we've got a lot of ground, of course, to cover in the state of Texas, and if we never left Texas, as we said when we launched, we could still have a really viable business, but. I expect that as we move into 2024, probably in sometime around the second quarter, I think we'll begin to start venturing outside of the state of Texas. We'll hit some of the neighboring states that seem to make sense. And then we've looked at some other big states across the country as well as to some of those that might be strategic and work well for us.
For those not familiar with the launch, Troy, why are you in the beer business right now?
Well, I worked for a distributorship back when I was in college, when I was transferring to UCLA, learned a lot during that summer. And then when I got to Dallas, became friends with one of the big distributors there. I've done a lot with that distributorship over the years. I've always liked beer. A couple of reasons, quite honestly. I'm obviously a lifelong athlete. I'm still very mindful of what I put in my body. And I felt that the beer, what was on the market had gotten a little bit tired, and I felt that it could be done better. So we went to work on it, and I feel that we accomplished that, Brian, because we're 90 calories, 2.6 carbs, but just as important, if not more important, we have no adjuncts. So we had no corn, rice, syrup, or sugars to our beer, and we're the only widely available beer that can say that. So it truly is a better for you beer, and I think it's that has resonated with so many of the consumers that we now have in the state of Texas. And it's the biggest reason why I wanted to be a part of it and make my own beer.
I follow you on Twitter. I have for a long time. So I woke up the other day and I saw the spot from you on your beer, 44 seconds. Maybe you could explain it for those that haven't seen it, because to me, it was, wow, I can't believe Troy Aikman just said all that.
Well, as far as our 4th of July post that we had,
that's correct.
Yeah. So it really, I'm very proud, of course, to be an American, as so many other people are. And when you look at this 4th of July, we're celebrating this great country of ours and the birth of our country. And I know there's a lot of beer brands out there that put an American flag on their package and claim to be American, but they're not. And so I was just basically encouraging those that are partaking and looking for a beer to drink, that if they celebrate the birth of this country and do it with an American-made beer. Certainly 8 is, but there's some others out there as well. And I feel that we've tried to stick to that. We've tried to be very authentic to who and what we are. And that's been pretty much our branding and our messaging throughout, as it is for this 4th of July holiday.
I'm sure you've seen what's been going on with Bud Light. It has been, and the sales continue to get worse. The outrage over what they did continues to worsen. So they are very much in trouble. As a leader of a beer brand yourself, can you ever imagine standing up a marketing program like they did?
Well, our approach, quite honestly, Brian, has always been that we're about the beer. That's what we're focused on most. And we've tried to convey that in every way possible. So I do feel that there are beer drinkers out there who are looking to land on a brand. And if authenticity and a company like 8 that's just focused on making great beer, if that appeals to you or to them, then we certainly welcome you to be a part of Team 8. And that's really been our approach. And how everybody else does it is totally up to them. But we just want to be about making great beer. We don't want to be in the middle of the debate. We just hope that 8's being drank when there is a debate going on, essentially. That's been our approach from day one, and it will continue to be as long as I'm involved with this company.
All right, well, of course, we have to talk a little football with you while you're here. Let's start with Aaron Rodgers, new team, Jets. How do you think he's going to do?
Well, I think he's going to do fantastic. I mean, clearly he's a great player. And I think the Jets in general, when you look at where they have been, I like that defense. They've got a lot of good parts. And now with Aaron Rodgers joining that team and 4-time league MVP, I expect the Jets to be right in the middle of it, as does the NFL. We've got a great matchup week 1 on ESPN Monday Night Football with Buffalo traveling to the New York Jets. So for the first opportunity for football fans to get a chance to see Aaron Rodgers as a Jet opening up the regular season on Monday night is pretty special for us.
It can't get any worse for the Jets. As someone who's followed the Jets for a long time, it can't get any worse. It's just, it can't.
Well,
it's just.
It's the power of a great quarterback, that you bring him onto the team. It wouldn't have mattered where he went. Immediately, that team then is looked upon as a contender. And like I said, I think there's a lot of good parts around Aaron Rodgers, specifically the way that the defense played a year ago, and a more productive offense is only going to make them even better. So I like the Jets. I would be surprised, and I know a lot of Jets fans would be disappointed if they're not in the conversation late in the year.
Well, if they're not, they might be calling for you, Troy, to come out of retirement, to get out of that broadcast booth and join them. I mean, seriously already. Well, how's that move been for you? Last time we talked to you, I think you were still going through the Fox talks, now on ESPN. How's it been for you?
It's been great. ESPN's been fantastic to myself as well as Joe. We've got a great team. They're on Monday Night Football. The first year was fantastic, and we're especially excited for this year. Like I said, with the schedule that's come out, we've got Philadelphia in a rematch of last year's Super Bowl, traveling to Kansas City midseason. So we've got a lot of really great games. Should be a lot of fun, and I'm super excited about getting the season kicked off.
That was Troy Aikman, co-founder of 8 Brewing, and of course NFL great, alongside our very own Brian Zazi. Well, coming up, we're going to check in on a few trending tickers that are moving after hours, including clothing giant Levi Strauss moving after reporting earnings after the bell. Those numbers and much more on the other side.
The question was, can the Biden administration unilaterally, or really any administration, forgive federal student loan debt under the HEROES Act based on an emergency, national emergency, in this case, COVID-19 being the national emergency there. And the question was, could they do that without approval from Congress? And this court here saying no in a 6-3 decision that goes back into repayment in September. So those payments are going to have to be made, or other arrangements to apply for other forgiveness plans. But this particular debt relief is off the table. There has been so much talk about the potential impact on inflation, that this could compound problems here in the United States with prices being so high, that now these borrowers are going to have to go deeper into their pockets and grab some money for student loans. And they've had this reprieve for over 2 years now.
Even the folks that we started with a plan when this was first announced, we obviously have been revisiting it in recent weeks in expectation of this announcement coming out. And now what we're in the process of doing is relooking at their situation, putting a plan together, looking at their budget to make sure that they're going to have sufficient cash flow to pay for these payments as they restart. The bottom line is, either way, these payments are coming, and you have to be prepared to start paying them or pay off the debt.
This ruling by the Supreme Court is not a surprise. Clearly, the White House was prepared for it. I think this is a messaging win for Biden, to tell you the truth, because he can say to voters, elect me again in 2024, make sure Democrats retake control of Congress so we can pass this legislation so that the Supreme Court can't undo it again.
Let's Let's take a look at a couple of stocks trending after hours. We got Levi's, Costco, and Biogen. Kicking it off with Levi's, we're looking at a loss of just about 6% here in extended trading. The company cutting its forecast, lowering its full-year adjusted EPS guidance. That's weighing on shares. They also cut the top end of its net sales forecast here for the full year. Second quarter net revenue declining 9% on a year-over-year basis. We know people have been pulling back on their discretionary spending amid high and sticky inflation. The drop in sales coming in the North America region. Also, wholesale revenue was a bit of an issue this past quarter. In the past 3 months, you're looking at losses of just about 6%. Let's take a look at Costco. That stock off just about 0.8% here in extended trading. June sales coming up a bit short, missing the street's expectations. Total comp sales declining 1.4%. The street was looking for a drop just about 0.4%. E-commerce sales also falling about 0.7%. Taking a look at the 1-month chart there of Costco, we're looking at gains of just about 4%. And rounding it out with Biogen, that stock up just by a fraction here in extended trading. FDA approving its Alzheimer's drug, Leqembi, expected to expand access here to this drug. Medicare promising to cover Leqembi. Now, this is the first antibody treatment to receive full FDA approval. The stock over the last month off by just about 5%. Year to date, though, looking at gains of about 3% over the last year, gains of 31%. So lots of focus on this drug, what it's going to do to Biogen's business. Again, FDA, its first antibody treatment to receive full FDA approval. We're looking at slight gains here in extended trading.
Well, it's closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Markets reeling from a stronger than expected ADP report. ADP saying the private sector added 497,000 jobs last month. That's more than doubling the estimate. That news sparking a sell-off in stocks and bonds on the expectation that the Fed will keep raising rates.
Meta's Twitter rival Threads launching with strong demand. Meta CEO Mark Zuckerberg saying that more than 30 million people signed up in the first day. And Twitter already firing back, accusing Meta of using its trade secrets. In a letter from one of Twitter's attorneys, the company is alleging that Meta hired former Twitter employees and had them working on Threads. A Meta executive denying those claims.
Finally, mortgage rates jumping in the last week. According to Freddie Mac, the rate on a 30-year fixed-rate mortgage is now 6.81%. That is the highest level since November.
Well, that does it for us today on Yahoo Finance Live. We'll see you right back here at 3 p.m. Eastern Time tomorrow. Have a great night.